Okay, let's unpack this. If you look at the global economy right now, you see these two massive competing forces, really.
Hmm.
On one side, you've got this just exponential engine of AI innovation. I mean,
Yeah.
record valuations demanding exponential resources. But on the other side, that engine is just smashing into some pretty profound friction geopolitics, domestic policy paralysis, resource scarcity, you name it.
Yeah, that tension, that's really the central story we saw across all the sources we looked at this week. We synthesized a whole stack, including some deep insights from, the titans of the chip industry, Nvidia's Jensen Huang, AMD's Lisa Su, and then alongside that, the hard economic data. The latest thinking from the Federal Reserve, the fallout from this U.S. government shutdown, and these spikes in key commodity markets like gold.
Right. So our mission today is to try and cut through some of that noise, synthesize these two worlds that seem kind of separate, and figure out what these real-world constraints actually mean for the future of the AI revolution. And we're starting where the action is hottest, the war for AI chip supremacy, which, wow, saw a pretty stunning power play this week.
Definitely. And when we talk AI chips, I mean, NVIDIA's position is, well, it's almost untouchable right now. They hold north of 90% of the market for those specialized GPUs that power AI training. It's huge.
90%.
Yeah. And that dominance, it's propelled their market cap to, what, an astounding $4.5 trillion.
4.5 trillion.
Yeah.
Okay, and their deals reflect that scale, right? We heard about Nvidia's plans to invest up to $100 billion in OpenAI, just building out AI data centers.
Exactly. And the key thing there, the real insight, is the strategic shift.
Uh,
OpenAI isn't just renting GPUs through cloud providers anymore. That's the old model. Now they're buying directly from Nvidia. For the first time, really, at this scale, it signals a new era of direct, massive infrastructure commitment.
Okay, so that's Nvidia doubling down. But then came the twist, the thing that really got the market buzzing this week.
Right. The sudden emergence of AMD as a potentially serious challenger, they announced this deal to sell many billions of dollars worth of their GPUs to OpenAI.
Many billions
Mm-hmm.
from AMD.
Yeah. And just for context, analysts currently say AMD has maybe a low single-digit share in this $250 billion AI data center silicon market. So this isn't just a big deal. It's a massive strategic bet for them and for OpenAI.
And the way they structured the bet
Yeah.
is, well, it's pretty wild, isn't it?
It really is. The structure is kind of shocking. OpenAI could potentially end up owning a 10% equity stake in AMD.
10% of AMD, just from this deal.
If specific stock targets are met over time, yeah. Even Jensen Huang at Nvidia, their CEO, he admitted he was surprised they'd give away 10% of the company before they even built it.
Wow. Okay, so is this just about keeping regulators happy, avoiding antitrust heat on Nvidia by propping up a competitor?
Well, that's part of it, probably. It certainly helps mitigate concerns about NVIDIA's near monopoly. Intel needed AMD back in the 90s. But I think it's deeper than that. This looks like a brilliant venture capital and supply chain strategy from OpenAI.
How so?
By taking a massive equity position in a key supplier, they're sort of vertically integrating their risk. They secure future volume, potentially cap their price exposure in a market totally dominated by Nvidia. It's smart.
So OpenAI is actively trying to build a more competitive supply chain for itself.
Seems like it. And AMD's CEO, Lisa Su, she definitely framed it that way. She said the commitment is a clear signal that their Instinct MI450 systems offer the performance and, crucially, the economic value needed to compete with Nvidia at this kind of scale.
Okay, and it's not just the chip makers, right? There are other players involved in actually building this AI infrastructure.
Absolutely. You can't overlook companies like CoreWeave. They specialize as an AI cloud provider, and they're landing enormous deals too. They expanded their agreement with OpenAI up to $6.5 billion, and they secured a $14.2 billion commitment with Meta. Huge numbers.
$14 billion from Meta alone.
Yeah. And they're innovating on the software side, too, rolling out new serverless reinforcement learning tools. It just shows the AI race isn't only about the hardware, it's also about making it easier to actually deploy the applications.
Okay, so the tech sprint is incredibly intense, but let's zoom out. The geopolitical backdrop feels even more fraught. Here's where it gets really interesting. If we connect this AI chip war to the bigger picture, this high-stakes race with China seems like maybe the defining challenge of the decade.
I think that's right. And Jensen Huang, someone who has every reason to be bullish on the U.S., he actually had some very sober warnings on this front.
What do you say?
His assessment was strikingly blunt. He said the U.S. is not far ahead of China, not far ahead. He stressed that we need a really nuanced strategy because China is already highly competitive in several key
Oh,
areas.
like what? Where are they competitive?
Well, for one, he said they're well ahead of us on energy.
Energy. How so?
China generated something like 10,000 terawatt hours in 2024. That's double the U.S. output. Double. He also noted China is right there on infrastructure and AI models. And critically, they have sophisticated domestic chip developers now, like Huawei, plus a really thriving startup scene.
Okay, so they have the power, the infrastructure, the models, the local tech. Where does the U.S. still have an edge then?
That's the crucial question, isn't it? And Huang argues the AI industrial revolution is actually one at the diffusion layer.
The diffusion layer. Can you break that down? Sounds a bit academic.
It does, but the meaning is pretty straightforward. It's basically the application layer. Huang's essentially saying winning the race isn't just about having the absolute fastest, most cutting-edge chip. It's about getting AI implemented everywhere, ubiquitously.
You mean like in factories, businesses, across the whole industrial sector?
Exactly. That's the diffusion. And his concern is that China's comparatively lighter regulation at the industrial level makes them quick in adopting new technology. They're apparently aiming for 70% AI adoption by 2027. That mass deployment, that widespread use, that's the real win, according to Huang.
And practically speaking, you just can't ignore the sheer size of the Chinese market, can you?
No way. Huang pointed out they hold 50% of the world's AI researchers and maybe 30% of the global technology market. You simply can't easily decide to walk away from that kind of scale if you want to be a global player.
Okay, scale brings us back to constraints, specifically power. You mentioned China's lead there. What about the demand side?
The demand is just staggering, mind-boggling, really. OpenAI's future plans alone, just OpenAI, require 10 gigawatts of data center capacity.
10 gigawatts. Wait, put that in perspective. How much is that?
Okay, think about this. That's roughly equivalent to the baseline peak summer demand for all of New York City, just for OpenAI's future needs.
That's insane. Is that even feasible? Can the grid handle that? Or is Huang just trying to push the problem onto someone else?
Well, he's definitely trying to accelerate construction because you're right, the existing grid likely can't handle it, not quickly enough. Huang argues the U.S. needs to rapidly build out power generation, and his suggestion is pretty radical. Data centers should generate their own power.
Their own power, like private power plants.
Essentially, yeah. Using things like natural gas, potentially even nuclear capacity to move faster than the existing transmission lines and the electrical grid can be upgraded. He's basically calling for the AI industry to become its own utility.
Wow. Okay, so chips, power.
Hmm.
What about the other critical input?
Hmm.
Talent. We see political friction hitting that too, right?
Absolutely. When Huang was asked about the Trump administration's proposed $100,000 fee for H-1B visas, he made it personal.
How so?
He grounded it in his own immigrant story. He said his own family, who immigrated when he was young, would not have been able to afford the $100,000.
$100,000 just as a visa fee.
That's right.
That's huge.
It's enormous. I mean, think about it. That's like a down payment on a median house in many places. And while a company like Nvidia, which sponsors about 1,400 visas, can probably cover that cost, Huang's point was broader. He stressed that policy should focus on enhancements to keep opportunities open for talent immigration, not build these huge financial walls.
It really feels like every foundational piece for this AI, boom, the chips, the power, the talent, it's all getting squeezed by these intense geopolitical and policy pressures.
Exactly. And that global friction, it's running straight into the wall of domestic political gridlock right here at home.
Yeah, let's talk about that domestic picture. This government shutdown, it's currently in its 8th day, right? And the Senate just keeps rejecting funding proposals.
That's right, gridlock. And the immediate pain points are becoming really visible and surprisingly acute in some areas.
You know, one that really stood out to me was the air traffic control situation.
Yeah.
ATC workers are deemed essential, so they have to work, but without pay.
Right. And the resulting shortages, maybe related to morale or just staffing issues, led to about 10,000 flights being delayed earlier in the week. 10,000.
And the FAA actually noted a slight uptick in sick calls among controllers. It's like a direct, concrete result of policy failure hitting everyday travelers.
And that failure just cascades, doesn't it? The IRS is furloughing almost half its workforce. That's about 34,000 people. But maybe even more impactful than the direct service disruption is how the shutdown is paralyzing the flow of information the whole economy relies on.
Exactly. It's delaying the release of really key economic data, things like the monthly employment report, construction spending figures, stuff businesses and policymakers need. And we saw reports it's even hitting commercial real estate deals, especially hurting retail and hospitality near places with lots of federal workers.
And this data vacuum. It's creating a massive dilemma for the Federal Reserve. We looked at the minutes from the September FOMC meeting, that's the committee that sets interest rates. Those minutes showed officials were actually strongly inclined to lower interest rates. They were worried about a weakening labor market.
Right, they were split, wasn't it? Like 10-9, a very slim majority expecting maybe 2 more quarter-point cuts by the end of 2025. They were getting ready to ease off the brakes.
Exactly. But the problem is, this ongoing government shutdown means the Fed is now, as one source put it, flying blind.
Flying blind, meaning?
Meaning they don't have the key up-to-date economic numbers for inflation and unemployment that they normally rely on. Those government data collection and release services are just paralyzed.
So they can't make informed decisions ahead of their next big meeting in late October.
Pretty much. They lack the timely data.
Okay, so you've got a Fed that wants to cut rates, but doesn't have the hard data to justify exactly how much, combined with a Congress that can't even pass a basic budget. When you have that level of policy uncertainty swirling around, it's really no wonder investors start looking for safety, is it?
Not at all. And that uncertainty is reflected almost perfectly in the commodity markets right now. Take gold. Gold is seen as the ultimate safe haven asset, right? A sort of fear indicator. And it just hit $4,000 an ounce for the first time in history.
4,000, wow. How much is it up this year?
An extraordinary 51.6% year to date. Just incredible.
What's driving that surge? Is it just the shutdown?
It's a mix of all the volatility we've been talking about, expectations of those U.S. rate cuts we mentioned, a broader recession fears, and definitely that domestic political uncertainty from the shutdown playing a big role. Some analysts are even forecasting gold could hit $4,900 an ounce by the end of 2026 if this uncertainty continues.
And it's not just individual investors buying, right?
Right. No, definitely not. We're seeing central banks, especially in emerging markets, consistently increasing their gold holdings. It's part of a diversification strategy, moving away from perceived risks in dollar assets like U.S. bonds. It signals a kind of deep uncertainty in the global financial system.
And that huge price spike, it's actually filtering down to consumers too, isn't it? Like with jewelry.
Yeah, absolutely. We saw reports that companies like Majuri had to update their prices because of rising gold, silver, and even tariff costs. And other brands like Bauble Bar are leaning more into demi-fine pieces, gold-plated instead of solid gold, just to manage those surging material costs.
Okay, so gold is surging on fear. But as an investment, how does it stack up long term?
That's the important counterpoint. It's worth remembering the long view. Over, say, a 30-year period, S&P 500 stocks historically returned around 10.67% annualized. Gold over that same period, more like 7.96%. So stocks significantly outperformed. The old saying kind of holds true. Gold glitters, but earnings compound.
Right. But the appeal of gold isn't really about beating stocks, is it? It's more about acting as a hedge.
Exactly. It's insurance. That's why some advisors might recommend allocating a small percentage, maybe low single digits normally, perhaps up to 15% in really uncertain times like now, because gold tends to do well precisely when typical assets, like your stocks and bonds, are faltering. It's zig when they zag.
Okay, so uncertainty is driving gold. What about the housing market? How's it reacting?
Well, we're seeing uncertainty hitting affordability there, too. Total mortgage application volume actually dropped 4.7% last week.
Even though rates came down slightly, I thought the average 30-year fixed rate dipped a bit to like 6.43%.
It did dip slightly, yeah. But clearly, that wasn't enough to entice buyers back in large numbers. Or maybe affordability is just that stretched.
So what are borrowers doing instead?
They're increasingly turning to riskier options to find savings. We're seeing a noticeable shift towards adjustable rate mortgages, ARMs.
ARMs, those are the ones where the rate is fixed for a few years, then it can jump up, right? Feels risky.
It can be, definitely. The rate adjusts based on market conditions after the initial fixed period, usually 5 or 7 years.
Yeah.
But the ARM share increased to 9.5% last week. And the reason is pretty clear.
Lower upfront payments.
Exactly. The average rate for a common 51 ARM is almost a full percentage point below the 30-year fixed rate right now. It's a really crystal clear sign that affordability is so strained, that borrowers are willing to accept that future rate uncertainty just for some immediate cash flow relief today.
What an incredible picture. Just this collision of forces. We started this deep dive talking about exponential technological acceleration, didn't we?
Hmm.
The AI chip wars heating up, CoreWeave rapidly scaling cloud infrastructure,
Hmm.
private capital, letting these tech unicorns stay private for, what, a median age of 13 years now?
Yeah, that whole world of exponential innovation. Yet, as we've seen, it's running headlong into these massive structural frictions. Things like government shutdowns, paralyzing the data flow the Fed needs, serious energy scarcity concerns, challenging the very possibility of building out AI infrastructure. Then you have immigration hurdles potentially blocking specialized talent, and this policy uncertainty spiking safe haven commodities like gold. It's
Right.
all connected.
And the market definitely showed its enthusiasm for acceleration this week, didn't it? Remember that AMD stock rally?
Oh, yeah, an impressive 43% jump just following that OpenAI deal announcement.
That one number really reflects the market's desperation, maybe, and the huge potential reward waiting for any company that can offer a viable challenge in that AI chip space.
Absolutely. But the fundamental question still remains, doesn't it? The AI race is accelerating exponentially. It demands exponential power, exponential capital. We know that. If the very foundation it needs to build on, political stability, a reliable energy grid, the free flow of specialized talent, if that foundation is continuously compromised by geopolitical tensions and domestic friction, can the exponential promise of this AI revolution actually be realized?
So what does this all mean for you, listening? Will these profound bottlenecks end up capping the growth of this AI industrial revolution that's clearly underway?
Right.
Will it force a slowdown? Or will private innovation and these massive capital injections like that OpenAI equity deal with AMD, will they just invent new ways to route around the policy failures and the infrastructure limits? That feels like the real dynamic to watch over the next year.